Hi, my name is Jordan Wilson. Today we're going to start to look at asset allocations and just some of the considerations that you will need to make when you decide how much you want to put aside for cash, for fixed income, for equity. Today we're going to look at cash. Our objectives are going to be just a quick recap of what is cash and cash equivalent asset class, why people should invest in CCEs. Then we're going to look at considerations based on the life cycle phase, the accumulators, the consolidators, the spenders. Don't think we'll worry about the gifting phase at this time. We'll consider some of the general needs and opportunities and the personal circumstances that people get involved with. And again, this is all more just to stimulate your thought as to what you might need, because everyone is going to be unique. And you can't have a cookie cutter approach to investing. It has to reflect, again, your investor profile, your objectives, your needs, your risk tolerance, your financial situation. So that's why you need to sort of sit down, assess your own life, create that investor profile, and that'll help drill down what an appropriate target asset allocation should be for you. Cash and cash equivalents. That's obviously going to be cash. It's also going to be sort of those short-term, let's say up to 1 year cash equivalents. Treasury bills, guaranteed investment certificates, term deposits, maybe even some very liquid bond funds made up of short-term bonds or other fixed income. But regardless, it's going to be assets that are highly liquid and very stable. And that means they're going to be low risk and give you low return. You're investing in them for that liquidity, for that stability, not for the return. They're useful for emergency reserves, short-term financial objectives, as well as obligations. So a short-term objective may be, I am getting married in 6 months. I need money for the wedding and the reception. I plan to move to a different city and begin a new career. I need money for that. Those are your objectives. Short-term obligations might be monthly rent, paying the utilities. So you need cash set aside to deal with your short-term obligations. And then for a lot of investors, have that little pool on hand for investment opportunities that arise out of the blue. The accumulators, if you recall our discussion on phases of life cycle, they are the, let's say, relatively young, starting out in their career. And if we look back on that discussion, it's not necessarily age, because maybe I came out of high school, I apprenticed as a plumber, an electrician, maybe I'm a carpenter building houses. So I could get my start, sort of around that age 20 after I apprentice, versus maybe I go to school for 4 or 5 years. And in my case, then there was a 3-year articling period as a professional accountant where you're not making any money. So you come out 4 years of school, 3 years articling, and then you start your career earnings. Maybe you're going to med school. Maybe you're specializing in a certain area, kinesiology or ears, nose, and throat. So you might not be getting started in your career until your early 30s. So the accumulator is relatively young, but more when you're starting out. It also could happen you've experienced a disruption. in the normal cycle. Maybe the economy was bad, you were laid off for a period of time. As we go through COVID right now, there's many people that have been out of work for coming up a year. Restaurants, bars, businesses are shut. They're going to have to start over. Or you could be a new entrepreneur. You decided in your 40s to sink everything into a new business venture. That's starting out as well. Maybe you don't have a lot of free cash flow. Now, the financial position for an accumulator tends to be that you have little capital, little wealth, not much savings. You don't make a lot of money, so your disposable income after expenses is probably quite limited. And that means that your free cash flow for investing or paying for unplanned expenditures that arise is also limited. Your cash requirements are often high because, again, when you're starting out, you probably are paying rent. You're paying for maybe a car loan. You're paying off your student loans. So you do need cash. And liquidity and dealing with your short-term obligations is of paramount importance. That said, because you are relatively young, you probably have a very, very long overall time horizon for objectives such as retirement savings. And if you recall our episode where we looked at time versus funding versus return and compound returns, we saw that if you start investing for the long run as early as possible, you can invest relatively little capital, but it'll grow and compound very effectively over the long haul. If you recall the ant versus the grasshopper, she invested from age 25 until age 40, $300 a month. I think she put away $54,000 of her own money. She didn't make any more contributions after 40, woke up at age 70, she's got over $1 million. Her twin brother, he doesn't start investing until he is 40. And to catch her, he has to put in $750 per month from age 40 to age 70, 30 years, for a total of $270,000. So if you think of it that way, maybe you can scrape together $100 a month or $200 every quarter just to get the pot going. Your asset allocation as an accumulator, probably 3 to 6 months cash reserves. It's hard to say what percentage of your total asset allocation that's going to be. It could be 5%, it could be 25%. The problem is that you have no wealth. So you could be setting aside 3 to 6 months cash reserves, and that could be every cent you have. So as an accumulator, it might actually be 50, 75, or 80% in cash. But unfortunately, that's probably what you need to be safe and to pay your obligations and deal with your short-term financial objectives. So that's going to be your allocation in cash at that phase of your life. Now, your focus at this time is probably paying down debt, because a lot of debt is going to be non-tax deductible. You're paying it out of your after-tax disposable income. And interest on debt is a negative return. So if I'm getting 5% return on a bond that I invested in, maybe I'm paying 30% tax on that. So my net return is 3.5%. But I'm probably going to pay like 6% in that scenario on my student loan or my car loan. And that has to come out of my after-tax money. So on a flipping, you'd have to earn 8% in a 30% tax bracket to sort of equate with a 6% debt. So you'd rather pay off your debt in many cases because that gives you a better return than investing. That said, you probably, just again to build the habit, to get in that frame of mind and to start seeing some wealth accumulating, you probably do want to try and start investing. Tax deferred accounts, tax-free accounts. Get the ball rolling, you start seeing some growth, and that positive feedback will help you when you get into the serious investment phase. And as I said earlier, what you see is that for relatively little invested today, over 40 years, 50 years, that can grow to a great amount. If we turn to the consolidators, those are the people in the middle of their careers, that sweet spot. Typically mid to late 30s all the way up to early 50s. Kind of your peak periods for earnings. Financial position, income is relatively high. By sort of age 40-ish, you've probably got your mortgage under control, you've paid off your student debts, car loans, so your expenses are relatively manageable. And because of that, your personal wealth has increased and your debt has decreased. And you're into that serious investing phase of life right now. And this is where you should be trying to seriously build up your investment portfolio for retirement. As far as an asset allocation, cash reserves are less a concern because your free cash flow and your disposable income from your job are adequate for dealing with your expenses. So maybe you want 5%. The other thing is that because you have more assets and they're spread out, you can probably start storing some of your cash reserves in slightly less liquid assets. You don't have to worry about T-bills or 90-day term deposits. Maybe here's where you can get into a 1 to 5 year bond ladder of a large mutual fund or exchange traded fund. Still relatively liquid. And because of the short-term bond aspect, your pricing is relatively stable. So you're not going to have huge volatility in when you need the money. So that's an area that people will start allocating. It's not cash, but you're sort of earmarking it for, well, if I need cash, I can access this and liquidate it pretty quickly and close to fair market value if I need to. So again, that alleviates the need for investing strictly in cash or putting the money in the mattress under your bed. Your focus here, you probably start to focus on short-term objectives, those of maybe more medium priority. We talked about the high priority, that might be buying a house in 2 years. Medium term or lower term, I'd like to buy a vacation property. I'd like to buy a cottage at the lake. I'd like to buy a condo in Scottsdale, Arizona. So things that aren't deal breakers. For example, if you lose your house as your primary residence, that's one thing. If you can't have a second home in Palm Springs or Scottsdale, that's not a deal breaker in the scheme of your life. And even on the lower end, the midlife crisis, I want to buy the Porsche when I'm 50. So that's sort of the secondary focal objectives. But as you reach that sort of 40 to 50 age bracket, what were medium priority and mid-term or longer term are now right in that short area where you're thinking about purchasing them. You also want to create some nice investment opportunities, reserves. because you're going to get more opportunities. And once you've built up a strong foundation or base portfolio, then that's probably the time of life when you start looking for complementary assets. Maybe a private venture capital fund or private equity fund, or maybe a real estate fund, something that sort of comes from a slightly different perspective to possibly add some diversification benefits to your overall portfolio. And while you're accumulating or in the early phases of consolidating, you still want to be building up that solid base. And then what you're seeing a lot these days, children's education, or for adult children these days, you're seeing a lot of parents providing financial support and buying their own houses, or going to post-secondary or farther on. So that might be a focal point. Again, you see that everything is sort of different depending on your personal circumstances and your personal desires. The spending phase is at that point right near or at retirement. So you want to enjoy life, you've stopped working. The thing to remember with this, though, is that even if you quit work or retire at age 65, you may have a 20 or 30-year time horizon left. Now, if you're 25 or 30 and starting to invest, and someone says you got 30 years, you think of that as a long time frame to invest. You can't just think, oh, I've retired from my job. I can just go into cash and fixed income because I want that safety, security, capital protection. You still have a long time horizon left. So you got to be careful about how much you put into cash and short-term, less risky assets. Your financial position, you probably don't have any employment income or business income. So you're going to be relying on your pension, your savings. Hopefully by now you had a high accumulated wealth. Your expenses are probably going to be lower than when you were working. But that's not necessarily true, and that's often a problem with retirees. It's like, okay, I've paid off my house, I've paid off my car, I've got no costs. And then the next breath, it's, oh, I want to take a cruise around the world, or I want to go down and spend 6 months in Buenos Aires, Argentina, learning to dance the tango, these sort of things. So a lot of people, when they retire, they find that their costs actually can go up. The other problem, I think, with the spending class, or those people sort of just post-retirement, is you're probably have a higher risk of health issues, and those would be sort of unplanned in a lot of cases. Your asset allocation, again, based on your situation, based on how much wealth you have, but again, sort of 5 to 10%, because you're going to have a lot of your assets shifting slowly over time into fixed income, which again is lower risk, lower return. So you probably don't have a whole lot that you need to worry about having cash immediately. You can liquidate and go from there. Your focal points, again, we talked, maybe there's health costs, maybe there's health issues in your family history that you want to factor in. Lifestyle expenses. Do I want to rent a place in Palm Desert every winter? Do I want to hang out in Tucson, Arizona? I know people that in the winter they like to go to South America because it's the opposite weather patterns from North America. And on a relative basis, it's cheaper to live and it gives them a chance to travel. So your lifestyle, how you want to spend your life. Do you want to join a golf club? Join a tennis club? Another focal point should be inflation. If you're investing a lot of your money in cash or low fixed income, you got to be aware that if inflation hits, then that could impact your real returns. And there's many times when your real returns end up negative. So you need to be aware of that as far as how much you allocate to cash. And the same is true as there's a component of costs that aren't factored into the inflation rate. So you just have to be aware of price changes that aren't in the official cost of living allowance calculations. Needs, opportunities, personal circumstances. Well, you have plan needs. Again, these cover whether you're an accumulator, consolidator, spender. So again, what are your plan needs? Maybe 3 to 6 months cash is good. Maybe it's not enough. Again, maybe you want to get married in 6 months. Maybe you want to buy a condo in Fort Lauderdale in a year. So you need to look at your own planned needs in the short term and adjust your liquidity accordingly. Unplanned needs, probably the biggest areas would be for accumulators. What happens if I lose my job? What happens if COVID hits and my restaurant or hair salon is closed for a period of time? What happens if my vehicle breaks down and I have to buy a new vehicle to get around? And if you live in Saskatchewan, you probably do need a vehicle of your own. What happens if the rent increases? For spenders, the big one probably is health. I can adjust. Okay, I don't have enough money. I can't travel to Europe this summer. But it's hard to deal with suddenly health issues. If we look at opportunities, probably the biggest area here is for the consolidators, increasing their portfolios, adding more diversified assets to the mix. And as we discussed earlier, the secondary objectives, buying the cottage at the lake, buying the midlife crisis Porsche, these sort of things. And then the last point would be personal circumstances will play a huge part in the amount that you ultimately decide to put aside for cash. If I'm in an employment industry that's very volatile, if I'm in Saskatchewan, for example, and I'm a miner with the potash mines, there could be layoffs there, and there have been. If I'm in the oil and gas industry, you kind of see boom or bust. In the good times, everyone's working. In the bad times, lots of layoffs. Compared to perhaps, let's say a school teacher or a nurse, where it's maybe more plus or minus, recession proof. You're always going to need the school teacher. You're always going to need the nurse, those type things. But if the economy in the oil patch goes asunder, then a lot of people are out of work. Your economy in general. If you're in a good location, great. I have a lot of friends in the Cayman Islands and the Bahamas currently. With COVID, the tourism industry has been shut down for almost a year. Hopefully they've planned for that and set aside funds. Location. A year ago in September, and a huge hurricane hit the Bahamas. So if you're living in a place where there's potential issues, then again, you might want to have a better reserve built up to deal with that. Personal risk, your tolerance. Some people in general have extreme aversions. They're not comfortable unless they've got cash on hand to deal with literally every inconceivable and conceivable crisis that could hit for the next 12 months. And other people, I'm not getting any return on that. I'll live hand to mouth and I'll deal with it if it ever happens. We all know people in both categories. So again, your personal situation, your personal circumstances, your personality will all play a part in how much cash and other assets that you allocate your wealth to over time. That's it for a quick look at asset allocations in respect of cash. We'll go through fixed income next time, and then equities. And that'll give you some ideas on questions to ask yourself when you start thinking of your asset allocation mix. Thanks for your time and have yourself a good day.